So thanks for having me this afternoon, and I'll be talking about not just Bloomberg but other data sources for systematic investment processes. I should make it clear that I in no way represent Bloomberg, nor have I ever. So I'm speaking purely from the point of view of a user, and in particular the use of Bloomberg and other sources for systematic investment process. So here are some of the tasks that we might take on a day-to-day basis as a systematic investor: data management, estimating our risk models, tree pruning, and performance attribution. Now, the odd one out there, in case you hadn't spotted it, really is tree pruning, which most people wouldn't consider a core activity, but I'm wanting to kind of play on some of the various areas where that does apply. So why Bloomberg? I think lots of people, are familiar with their Bloomberg terminal. If you work in finance, you've probably got one or access to one. It's got incredibly high quality data. There are many eyes watching this data, and so if there are any errors, they're probably going to be spotted by one or more of the 200,000 plus users of the terminal. Support's exemplary. And the coverage of data is kind of growing all the time. They've always had exchange-traded over-the-counter derivatives and third-party analytics, but they're building out their proprietary data, including indices. They've revamped the whole industry classification, and they took on rebuilding essentially what was originally provided as IBES and other providers of analyst data, and done that, redone it themselves. And I'm not even talking about Port this afternoon. They do point-in-time universes in the form of index constituents, and this is incredibly important, as I'm going to be highlighting if you're wanting to backtest systematic strategies. Their identifiers, everyone knows the Bloomberg tickers, but behind the ticker is the unique identifier, which is not volatile. And this is really valuable for entity mapping across the asset classes. And I think it's this attention to detail that really makes Bloomberg so attractive. Plus their business model. I mean, I moved to Bloomberg from Reuters in, I think, 1992, and they had this all-you-can-eat business model, whereby their rationale is that any individual user is not going to use the whole, but they have it all switched on for everyone. That doesn't go for third-party data, of course, but I just think it's a wonderful feeling to know that you can explore any part of this system, even if it's way away from your core interest. And it's zero marginal cost if you've already got a Bloomberg terminal. So I'm not going to talk about the limitations on this all-you-can-eat, because there is a daily limit and there is a monthly limit. But what you can get within the monthly limit is many times the multiple of the cost of your Bloomberg terminal license. So, and as our users, we've had our BBG for a number of years now. It was off CRAN, and it was kind of not really being actively developed. Now, thanks to Dirk and John Lang and Whit Armstrong, we've got the CRAN package, RBLP API, which, as far as I've been a user of RBBG, so I'm not really speaking about RBLP API this afternoon, but it looks just great. And it's on CRAN. So if we focus on backtest simulation for equities, we need to be very rigorous to avoid hindsight and survivorship biases, both at the country level and at the stock level. So you either trust you've got two alternatives. You either trust your supplier of point-in-time data, or you use data that was originally published publicly and has been scrutinized by all those people in real time, so you know it was all known at that time. And the starting point really is the investment universe as an equity manager. So a great place to start, sorry for the typo, is index constituents. And so the question is which indices you're going to use. And actually not a bad place to start if you haven't already licensed, for example, one of the big providers. is B-World. That's now got 12 years of history, and you've got the constituents going back 12 years to August 2003. So here's how we might use B-World. And by the way, this whole presentation, sorry, it's done in Slidify, but that's actually the code fragment to produce this table via RBBG, data table, and then cable into Markdown and Slidify. And what we can see, so what's really nice is this compact syntax. If you're a big data table user, you'll recognize how you can write your code out sideways instead of vertically. Some people like to do. And B-World is an interesting index. It goes down to below $1 billion US market cap. It's got around about the numbers fluctuate, around about 5,000 constituents. Total market cap around $51 trillion US as of the start of this month, broadly split across 3 regions. At the moment, it's a bit lopsided towards the US, but these things tend to mean revert. So how are you going to use this? Well, okay, this is only one way of doing it. So I'm just describing what I do. And you need to be compliant with the Bloomberg data license. That means keeping it locally on your machine. A couple of obvious places, one obvious place not to put it is your package directory. Another place you might want to put it, but maybe you don't want to, is your user area on a Windows machine. So one place you can put it is in a location pointed to by this wonderful package from the Hadleyverse called Raptors, which points to your app data area, your local app data area. And so what you can do is build out and rip down a directory tree in that area, kind of with impunity, because you're not going to mess with anything else. So that's what I do. And you can do parallel downloads at really quite decent speeds. I use around about 20 processors concurrently in Snowfall, and it works just great. Obviously, there's many other ways you can do this. Moving on, another asset class. Here we're looking at agricultural commodity futures. So there's the top 10 most liquid ag futures. Much smaller open interest here, but it's quite a liquid universe. And all of this table is straight off. It has been done in using the same technologies and via RBBG. One of the great things, and the reason I'm highlighting this, is that it's all in the detail. And when you're dealing with futures, you need to roll them. And so you can invest quite a lot of time on kind of writing your own algorithms for systematically rolling futures contracts, which expire in every 2 or 3 months. But Bloomberg have tickerized all of this for you. So here, for example, I've broken down the ticker. You can have a roll type, which is basically the event which triggers the roll, and then a delay with respect to that, a lead or lag, and then the adjustment, which is either based on the price difference of the term structure, or on the ratio, or no adjustment if you want to do that for some reason. This is really great because they've made it really easy for you to avoid all of that kind of back-end data homogenization. This is a topic I'm quite interested in at the moment, which is residential property. In the US, we've got the S&P Case-Shiller National Home Price Index for single-family homes. We've got an equivalent in the UK, which is called the price paid data from the ONS. And from that, we can actually construct high-frequency and highly granular indices. And this is really interesting because from that, we can build risk models. And this is something I'm working on very actively. Just in case anyone's drifted off, here's a little quiz. Which graph is which asset class? And you can probably guess the one on the red line is the agricultural commodity, And the spot price has been volatile and sideways, but once you look at the roll cost, it's been really not an asset you want to be long of. Residential property, the green line, had a bit of a blip around the crisis, but it's been a great asset class. And and equities in local currency has been kind of volatile and up over that period. Risk models. So risk model is at the heart of most systematic investment processes, and it's got applications across just forecasting vol, portfolio construction via optimization, fundamental valuation, performance attribution, so loads. It's right at the core. And why do we go for the statistical type as opposed to the fundamental or macroeconomic type? I'm not going to go into the differences, but it's really great if you're just using it for the purposes that I've described there, as opposed to storytelling. It's got really high explanatory power, both in sample and out of sample. And it generalizes across all of these asset classes because it's purely price-based. And Pat Byrne's BurstFin will provide you that functionality. So this equation 1 here is the core of the PCA factor model. The matrix, the square matrix, gamma lambda here is reduced rank to K factors. And it's those K factors that are the systematic risk drivers in any portfolio of these asset returns are. So there's some issues with this type of model. We don't know how many factors to use a priori. And the returns appear on the right-hand side as well as the left-hand side, so you're explaining returns with themselves. And lambda and gamma are both derived from the return covariance matrix, so that's also, in a way, a separate issue. So one of the ways we can approach this is with the wonderful machine learning approach of cross-validation or statistical learning, Hastie and Tibshirani, and do that regression and then drop one row at a time from the estimation of the variance. And also we can rearrange the equation to remove the asset from the right-hand side and shift it over onto the left-hand side. Anyway, what's great about that is that you can then apply the concept of parameter tuning. So instead of the red line, which shows ever-increasing explanatory power as you increase the number of factors in a PCA model, going from 55% here up to 75%, you get the classic textbook type of curve, the blue line, which shows that around about 10 factors you get the best out-of-sample performance, and that's what you care about. And by the way, these R-squareds are really quite respectable, somewhere between 55 and 60% on a liquid European equity universe. So you can then apply this across the different asset classes, not just equities and commodity futures, but residential risk, and they've each got their own kind of characteristics of breakdowns of sources of risk. I think what's interesting is that there appears to be actually an inverse relation between the return and the risk as measured by volatility across these asset classes. So another thing you can do is recognizing that risk is multidimensional. We're here looking at the output of the PCA model, and the horizontal axis is loadings 2 on factor 2, vertical axis loadings on factor 3, size is loadings on factor 1, the directional factor, and the color represents the grouping of futures here. And what's quite surprising, because this doesn't happen for equities, but here the sectors of futures do group nicely. So you've got energy on the bottom left, and you've got agricultural grains on the bottom right, etc. So that's really nice, and we're using Google Viz clearly here, although this is just a screenshot. And here's London residential, so we can do monthly indices at the postcode area level. So, for example, Southwest, Twickenham, or Romford. And what's quite interesting is that, so we can get loadings on factors 1 and 2, we can get the standard deviation, and also the average value of the properties. And I think what you can see straight away is that they're all correlated. So factors 1 and 2, their scores are not correlated by definition, but actually the loadings are, in this case, positively correlated. And we can watch that through time, and it's a really interesting story to tell. The other thing is that factor 2, although the scores are zero correlated at lag 0, they are actually positively correlated after a lag. And we're now seeing that right now in London, that peripheral zones are catching up with prime central London. Classification trees apply across all of these asset classes in different ways. We can use them for screening. We can use them in portfolio construction to design neutral portfolios, market neutral portfolios, or in valuation, for example, of equities as the sum of the parts. So we factor up, we apply a multiple, for example, to earnings or revenues for each of the sub-exposures of a stock. And we can construct pure play portfolios. Now, you can do some of these things in Bloomberg, but really there's a limitation to the kind of analytics that you can do. And it's great to build out onto R and use core routines from data table, quadprog, etc., to do really fast and insightful analytics. And the Bloomberg industry classification system is an amazing thing that they've rolled out, I think, about 3 years ago. And it recognizes that stocks are often diversified across industries. So you've got an overall stock classification, and then you've got fractional exposures to industries. So here's the example of PepsiCo, and it's got exposures to snack foods, soft drinks, and breakfast cereals. And by the way, this is by no means a highly diversified company. And so you end up with this incredibly granular data. There are 2,200 nodes on this 7-level tree. If you look at the top 1,500 stocks, they're actually globally, they're allocated to 480 distinct industries, and they have fractional exposures to 1,148 distinct industries. And I've shown in the table how that breaks down by level. So you might kind of go, well, this is way too granular for my purposes. Whichever one of those applications you're looking at, you don't want to be neutral on every single one of those micro industries. So you need to prune. And so I've just thrown up a little code fragment there about how you might automatically prune to achieve at least 15 revenue segments or 15 companies as a minimum on each node. And then having done that, one thing you might want to do is to actually check it and visualize it. And what I actually do is shell out and build a directory structure to represent the classification tree on the Windows file system, which surprises some people that anyone would actually do that. But it's quite nice, actually, because you can then share this with whoever. You can send a zip file with just the tree structure, and you can show the results of your pruning and editing. And you can also do manual editing, dragging and dropping revenue segments, for example, up the tree. And you can then visualize it using, for example, your file management tools. Here we've got the Bloomberg World stocks. Every lozenge on this color display is one stock. And there are a total of 10 different colors. Each one of those corresponds to a file extension that represents the sector allocation of that stock. And the one that's highlighted, the little gold lozenge in the top right, is Apple. And the size of that is a representation of its market cap. It's a little bit smaller now than it was when I made this slide a couple of weeks ago. In case of property, we also have a classification tree. It's called the postcode. And so in case you don't know, well, I'm sure you do, you know that the postcode's got two parts, but the part on the left has got two parts, which is the outbound, is called the outbound code, and the part on the right is called the inbound code. and both of those split down into on the left the area and district, like SW is the area and 1 is the district, and then there's the inbound code with the sector and unit. And I've shown here the example of the Tower Hotel, and you can very easily then screen around that to a radius or to a unit or sector. And so we're down to a similar problem in terms of customizing a classification tree. I'm going to talk very briefly about attribution, so we can attribute through the risk model ex post return or ex ante return. And ex ante return one, so there are many ways of thinking about what to expect a stock to return. But one thing you might do is go to the analysts with the best return forecast track record, and Bloomberg do this, and they've been doing this for 10 years now, and they've got a system called BEST, which is really a clone of Starmine, and so you define upside as the analyst target price divided by the closing price minus 1, and you could think of this as a proxy for the equity risk premium. And then you can customize. You want to customize the pruning of that industry classification tree, and then solve by regression for the upside on each of those industries. And yeah, well, you get what's amazing is the other thing you can do is pass it through the risk model. So I just described using the industry model. You can also pass it through the risk model, but the risk model that was estimated on ex post returns. What's really interesting is that it works equally well for ex ante returns. And both factor 1 and the lower ranked factors are highly significant in this regression, and the bias is really small. And I think this is really interesting. It tells us about systematic factors and expected returns. Here's the example of PepsiCo. Its own time series of analysts' expected returns for that stock and expressed as upside, and what you would get just from a risk analysis. So if you looked at its risk-matched proxy portfolio. This then is a bit of performance attribution and how we get insight into how we can tweak a systematic investment strategy. And the systematic investment strategy here that I'm looking at in the chart on the left, which is, and it's the blue line, is a backtest of that strategy, is where you're market neutral, you're directionally neutral in futures, in commodity futures, but you go long the ones which are in backwardation, so you're rolling up the curve as you go to expiry, as opposed to rolling down the curve in contango. This is not a new strategy, and if you look at that curve, actually the last 2-3 years, the blue line has been relatively flat, and probably quite a crowded trade by now. But what's really interesting is if you attribute this between residual and systematic returns, the green and the blue lines, and the red lines, that actually if you eliminated the systematic component through optimization, you'd get a higher Sharpe ratio. So this is the kind of insight that you can get by applying R on top of Bloomberg that just isn't available inside of the system. It's very relevant to systematic portfolio managers. The other one on the right is, again, those two components, but now we're treating portfolio construction as an event study, and so we're lagging the portfolio positions with respect to returns, saying, what if we implemented these positions early? Well, it's a momentum type strategy. If you think about it, it's almost got to be. So on the negative lags, you've got positive performance, so you're buying into futures that have performed positively and selling ones that have performed negatively, and that's how you got into that situation. But what it's telling you is that it's not urgent to trade to get into these positions, that the performance actually gets off to a slightly slow start around 0 and then persists for up to 20 or 30 weeks. And you can also see how that varies according to risk component. And these are the type of analytics that I think really add value on top of what Bloomberg's got. So conclusions, by the way, I'm not giving investment advice. Bloomberg is a comprehensive data resource. We need to add additional analytics, especially for risk model-centric type questions. And no, don't sell the farm and buy the flat. It's probably the wrong time for that. This is the roll of honor. Huge thanks to the people who did RBBG, which I'm still using, but I'm sure I'll be migrating onto RBLP API really, really soon. And data table, just fantastic. I've moved off MySQL and just use native RData files for everything. And Hadley Wickham obviously isn't generally credited for Raptors, but is one of his contributions. Please, by the way, I didn't mention, I have actually put up, as of yesterday, a Shiny Apps application that explores that whole residential risk side of things. So I do invite you to, it may not be up for very long, but I do invite you to have a look at it, and it's just an alpha test version, so it's not got a lot of explanation on it, but I think you might find it quite interesting in terms of characterising London property, especially for those of you who, like me, are London residents. It's kind of very interesting. So I'm gonna leave it there. Thank you.